what the purpose of this meetup is just to introduce people to investing basics, mostly concentrating on mutual funds, taxation, that kind of stuff. There is no selling of any kind. I am not a financial advisor. I'm not a financial planner. I can't sell you anything. This is not investment advice that I'm giving here. It's for educational and entertainment and demonstration purposes only. And it's not a solicitation to buy or sell any securities. So we're just kind of chatting here. I'm a random guy on the internet. And I'd like to give a shout out to my sponsors, Oak Avenue Neighborhood Hub Society and the Neighborhood Small Grants, who have provided the funding for the Zoom and the meetup.com membership. So this time I've opened up the group chat as well, so I can see that. Let me start off to see if anybody has any questions about the previous presentation or what we're doing here and so on. Anybody have any follow-ups from last time? All right. So I'll go ahead and just do like a really quick overview of what we covered on the first one, and then we'll keep going. So the first one we talked about the various terms that are related to investing. So we talked about the difference between a stock and a bond, what an index is, what actively managed versus passively managed means. What a bear market is, bull market is, the capitalization and the sizes of the companies. We talked about the differences between stocks, exchange traded funds, and then what a mutual fund is that's actively managed versus a passively managed mutual fund. We covered risk. Meaning what sort of investments do you want to get into based on your risk friendliness. So you basically, and this is quite important, what sort of risk are you able to handle both psychologically and financially? So for example, this week the market's been dropping. If that affects you, you're probably not good to be in stocks. If you see that as a buying opportunity, then maybe stocks are for you. Also, are you able to handle it financially? Meaning, do you need the money to live off of? And then finally, getting financial education and learning for yourself. That'll also increase your risk awareness and capability. The other things that will affect the type of investment that you want to buy is the time frame when you need the money back. So if you have a 6-month time frame, then you probably want safer investments. And then finally, the return that you need. You don't want to get anything riskier than you actually need. So that's how you're kind of you have to get your risk awareness down, or your financial advisor, if you have one, will help you with that. So stocks are generally more volatile than the bonds, for example, and then closer to home is usually perceived to be safer. Larger companies tend to be safer than small companies, obviously, and then bonds in general are less volatile than stocks. So the other thing I cautioned was for people to have an emergency fund, so you don't have to sell your stocks or your stock mutual fund or your stock ETFs after they've gone down if you need to live on them. The other thing is that if you have a lot of equities in whatever form, that you might want to have some cash on hand in case there is a crash, that you can take advantage of it. If you go into a crash without being fully invested, without having any cash on hand, then really all you can do is sort of ride it out. So that was that. I showed this wonderful graphic that illustrates risk versus return, where the stuff that moves up and down the most ends up the highest in terms of returns. So then I had a table of asset types where I talked about the difference between, in my opinion, this is just my opinion, and there's lots of people who disagree, where I have investments where there's a steady stream of income or cash flow versus speculation where the asset goes up because somebody else places a higher value on it. And then gambling is where you don't even expect the asset to go up. I mean, it could, but it doesn't have to. Then I try to impress upon everybody the importance of starting early. Those of us who can, if you're young, you can do $100 a month investing, and you'll be a millionaire by the time you're 65. While if you wait until you're 40, now you have to do far more. So it's just the illustration of compound interest. The earlier you start, the more time your investment has time to compound. I also talked about the importance of low fees, which have the same effect. And contrary to what most people would think, is the fees take away from performance, and it's not proportional. So if I have a 2% MER fee and I'm getting 5% instead of 7, it actually halves the performance. It doesn't reduce it by 20% or something like that. So just be aware of that compounding, it's a curve, it's not a line. Right. Just my point here was that the stock market goes up over the long run. There might be some deviations where there's losses, but overall the stock market goes up. So if you have a long-term time frame, you'll do well in the stock market. In the short run, though, nobody knows, and anybody who tells you with certainty that tomorrow the market's going to go up or tomorrow the market's going to go down, they're wrong. They cannot know with any certainty. So they have an opinion. We all have an opinion, but the only thing you can say is that over the long run, historically, the market's gone up. So then we talked about some strategies. One is lump sum. You just put $10,000 in and let it go. If you don't have $10,000 and you want to be putting money in as you're making it, then dollar cost averaging, where you buy the same dollar amount of the same asset month after month, quarter after quarter, whatever floats your boat. Then if the market goes down, you're able to buy more of that asset. And so you're able to take advantage of the loss. If you're making decisions on your own, and actually, let me go back. Rebalancing is an important point, where if you've chosen a certain proportion of your investments to be, for example, 60% stock mutual funds or stock ETFs and 40% bond ETFs or mutual funds, and then at the end of the year, the proportion is no longer 60-40, then what you want to do is rebalance. So that gets you back to the risk profile that you've chosen as feeling good about, because now you're more exposed to whatever you didn't want to be more exposed to. And you're also selling high and buying low as far as your portfolio is concerned. So every 6 months, every 12 months, there should be a check for this proportion. And again, keep in mind, it's the proportion that matters. Both investments, or all three investments, could have gone up, or one could have gone up, one could have gone down. You're just trying to restore the proportion. So I've run this with 3 different investments, 4 different investments. After that, it starts getting a little complicated. But some people will just have like 2 mutual funds, and they'll try to keep them balanced. All right. If you're trying to have some personal input and you're a little bit more active, then the guidelines are sell when the markets are expensive and buy when markets are cheap, when there's panic. You're making your own choices, trying to outperform the market. And of course, you're also trying to outperform all the experts. We all try it. Most of us fail at it, which is why just buying a low cost exchange traded fund or a mutual fund and just letting it go, it seems to be the long term winner. And a lot of people are their own worst enemies because they work on emotion when they're investing, because we're human. So something's going up, it's like, yay, oh gosh, I'm missing out. So you buy in at the top. Or it's falling and it's like, oh my God, it's going to go to zero. I got to get out. So we're usually our own worst enemy. But like I said, we all try to outperform the market, and it hardly ever works. So on that note, when markets go down, you basically have a couple of choices. Well, three choices. One is you could sell, which typically is the worst thing to do, especially if you're reacting to a statement which arrived 2 weeks after the end of the month, and so it's 2 weeks out of date. And if you sell, you might be the market's already dropped. Who knows whether it'll keep dropping or not? Like, nobody does. But generally, what financial advisors advise is do nothing. Just stick with it, and it'll come back up, and eventually it does. And if you are brave, you can buy more because you're taking advantage of the low price. Okay, so that's kind of a recap of what we covered last time. So now we're going to get into a little bit of taxes. My apologies, but I think at least being aware of the taxes and just making some very simple decisions based on taxes will let you set yourself up for success when you're investing. Okay, so this table, I have to be honest, the main reason I put this in is because I ask people, what kind of investments do you have? And they tell me they have some RRSPs. And RRSP is an account type. What I'm asking about is the investment vehicles. So generally, these are the Canadian account types. So you got your RRSPs, your TFSA, registered education savings plan, registered disability savings plan, which is great to take advantage of if you're in that unfortunate position. Once you're retired, or if you have a pension plan from a company that you left, these are locked in accounts of all sorts. And then finally, you have the catch-all non-registered or cash account. And pretty much you can have anything in any of them. The only one that I found was you can't seem to own real estate in the TFSA. TFSA doesn't have much of a limit anyway, so it'd be unlikely you could own real estate. I found this, that for RSPs, you can't hold any businesses where you have an interest of 10% or higher. So for example, if you have your own corporation, you can't have it in your RSP. Precious metals other than gold and silver, commodity futures, private holding companies, private foreign companies, your own debt, personal property are non-qualified for RSP. So there's a bit of an asterisk on the RSP as well. But yeah, you have lots of freedom, but obviously check with the CRA and or your financial advisor if you have one. All right. As I've said in the previous meeting, if you have any questions, please just interrupt me and ask. As I said, I have the chat up, so if you want to type your question in there, you can as well. But this is for you. If you're not following something, let me know. Okay. Kind of a guideline as far as which vehicle to use when. So this is based on the fact that in most brokerages, you pay commissions when you're buying stocks or ETFs, and you do not pay commissions when you're buying mutual funds. And so if you have a lump sum, if you have a $10,000, $5,000, something like that, then you're okay to buy an ETF or a stock and pay that $6 to $10 commission, and then have the LOMER in the ETFs and NOMER in the stocks. However, if you're making small purchases on a monthly basis, for example, I'll show you later, I do mutual funds because they don't have a commission, but they do charge a higher MER. If your brokerage has a list of no commission ETFs, or if your brokerage allows purchases for no commission, whether of stocks or ETFs, then that would be a way to go. There could be limits on that. With stocks, you might have to buy whole shares, for example, and so on. So if you're doing $200 a month, that may still not lend itself to that, but that's so. This is kind of a guideline. Once you have a plan, get your brokerage based on that, and then you can determine what vehicles you want to use. All right. So taxes and account types. So let's deal with the RRSP first. That's the Canadian basic. It's been around since the 70s. So an RRSP is bought with pre-tax dollars, or alternately, you can think of it as lowering your income, or alternately, you can think of it giving you a tax refund after you buy after-tax dollars. So for example, you're making $60,000 a year, you buy $10,000 of RRSPs, that lowers your taxable income down to $50,000. Or you could think of it as, I pay taxes on all 60, then I bought RRSPs with $10,000, and I'm going to get a $3,000-$4,000 tax refund. The math works out exactly the same. It's just different ways of thinking about it. I'm going to say RRSPs are using pre-tax dollars to make the purchases. So in general, and I'll have a very nice diagram later, RRSP is to be used at the top of your career when you're in a high tax bracket to lower your taxes. For an RRSP to actually give you a benefit, you need to be in a lower tax bracket when you're selling the RRSPs to live on than when you bought it. So if you're making $100,000 a year, you buy your RRSPs to bring your tax bracket down and to get the maximum benefit of the tax deduction. And then you want to be selling the RRSPs when you're in a $50,000 a year retirement or tax bracket, or in a year when you took a year off. That's all fine. Just keep in mind that the RRSP room doesn't recycle. Once you put the money in, your RRSP room is gone. This is different than the TFSA. Now, what you do want to be aware of is that the money that's in the RRSP grows in there without getting taxed until you pull the money out of the RRSP bucket. Within the RRSP bucket, you can trade back and forth, buy mutual funds, sell mutual funds, stocks, whatever you have in there. You don't pay any taxes as long as it stays in that bucket. Do not pull the money out. That's when the CRA wants its taxes. But that's when you get taxed fully, and I'll show you a tax table as far as what I mean. And so your RRSP limit. I'll just finish this thought. The limit is used up when you make a purchase. So when you work for a salary or for wages, you build up your RRSP contribution room or limit. When you buy something, your limit decreases by that amount. You don't get it back. So I have a question. What's the reason we cannot buy property stock on TFSA? You can't buy real estate. You can definitely buy stocks in a TFSA. You can buy something called a REIT, Real Estate Investment Trust. That's all fine. But apparently you cannot hold real estate in a TFSA. you can in an RSP. Uh, yeah. Okay. So everybody's sort of clear on an RSP. Most people sort of knew what an RSP was previously, or at least have heard of it. I'm hoping. Okay. So TFSA. So tax-free savings account. Whoever was the marketing genius behind that name should get fired. The S savings has screwed up so many people in that they put the money into a real savings account in a bank. In fact, it's an investment account. You use after-tax money, but whatever goes in there grows tax-free. And then when you pull the money out of the TFSA bucket, it will also be tax-free. The other thing is anything that you withdraw recycles your limit. Now your limit right now is only about 6,000 a year, but if you hadn't invested anything previously, I think it's up to 72,000, give or take, if you hadn't invested previously into a TFSA. But if you put money in, the money grows or doesn't grow. Anyway, you whatever you pull out, January 1st of the following year will get added back to your limit. So that's kind of cool, unlike the RSP limit, which you lose. So now, as far as usage of the TFSA, you would want to use it when you're starting your career, when you're still in a low tax bracket. At that time, it's not really efficient to use RSP room because you're in a low tax bracket, and so the RSPs will bring you to a lower tax bracket, but it won't be a significant percentage difference, which I'll show you in the tax table in a bit. And the low taxes make it cheap for you to actually get the after-tax money to put into the TFSA. So I'll get to the comparisons, but I wanted to show this table. So on the y-axis is your earnings, how much money you have coming in, whether from a job or from investments. And then here is time. So we're assuming out of school, you start at $30,000-$40,000 a year. That's when you want to be in a TFSA, because your taxes to get the money to put into the TFSA are relatively low. You're in a low tax bracket. And even though you're accumulating RSP room, it's not really worth using up that RSP room at that point, because you're in the low tax bracket, so you only get back a couple of percentage points. However, as you ramp up your career, and I mean, we all hope that we're going to keep making more and more money, but I mean, eventually you get to whatever it's as good as it gets. So that's when you want to switch to an RSP, because now it will help you, because you're in a high tax bracket. Buying the RSPs will knock you down and will get you into a lower tax bracket. And then finally, when you retire, the withdrawal of the RSPs, TFSA is tax-free no matter what. You can pull that out at any time, but the RSPs have to be withdrawn in a lower tax bracket than when you put them in if you want the benefit. So that's kind of the strategy. I have to confess, I had a friend who didn't consult me, who's kind of in his peak earning years, and he got himself a TFSA. I don't know why his financial advisor recommended a TFSA, but an RSP would have helped him far more. So some comparisons. So if you have any, okay, let me scroll down here. So this is combined federal and British Columbia tax brackets. Okay, there's separate tax brackets for BC and for federal. This chart combines them. So let me be perfectly clear. This is for marginal taxation. So for example, if you're in this tax bracket, you're making $90,000 a year, so you're in this tax bracket, and you make $1 more, you get taxed 31 cents on it. If you just drop into into the next tax bracket, only the money in that dollar range gets taxed at that tax rate. It's not that you drop into the next tax bracket and all of your income gets taxed at that tax bracket's percentage. Just to be clear, because I've met people who thought that. They're like, okay, I'm gonna make $5 more and then my take home is gonna drop by 10,000 because all of my income is now gonna be taxed higher. Everybody needs to be clear on that. So there's kind of 4 tax columns here. Let's just go through them. So capital gains is if you bought an asset, whether it's an investment property, it's a stock, it's a non-registered mutual fund, and you bought it here, you sold it here. The difference between the prices, if it went up, is called a capital gain. If it went down, it's a capital loss. That gets taxed in this column. If you're collecting dividends, if they're Canadian and they're from certain publicly traded companies, Canadian banks would be an example. They fall into this column of eligible Canadian dividends. And you can see up to about $50,000, you actually don't pay any taxes on those at all. So this is an encouragement by the government for you to buy Canadian. Non-eligible Canadian dividends would be still Canadian companies, but maybe not publicly listed. It could be other things. That's really the only example that comes to mind. So the other income is everything else, and that's taxed the highest, and it includes taxes earned on interest, on salary, on wages, and on RSP withdrawals. So when you pull your RSPs out, when you get salary, this is where you get taxed. It's always going to be double of what capital gains is, and it's always going to be more than anything to do with dividends. If you're a conspiracy theorist, you think that the rich are trying to screw the poor working people. If you're a capitalist, you think that the investors make the economy go around, they take the risk, and therefore they deserve the reward, so that's why they get taxed less. Sorry, I'm getting questions here. How is the tax rate negative on Canadian dividends? So that's a bit of an accountant question. I don't know whether you actually get a refund. Hardly anybody ever lives off of dividends only, but the point is you don't really get taxed until you get into this tax bracket. As you can see, this tax bracket's 47 to 81. So I kind of eyeballed it. I said around 50,000 of dividend income. That's kind of when you start getting taxed. Even then,
actually partially live off dividends. So one of the things I can say, because I just did my taxes, is that there is a dividend credit that is applied to a certain limit. So because a credit is applied, it actually is more than the interest rate that you would pay. So they do the calculation and it's applied up until, like you said, right about $50,000.
Perfect. Okay. Yeah. So I mean, it is a strategy. It sounds like for both JM and myself, where we want to live off of dividends. We're forced into Canadian dividends. Just as a sort of an advanced note, dividends from non-Canadian companies also get taxed here, and most foreign companies will generally grab 15 to 20% depending on the country. I think US does 15%. They'll just swipe that right off the bat, and then of course you pay currency exchanges and so on. So yeah, that's so this is important in that RSPs are great. You get a tax write-off, and obviously you're earning salary probably when you're buying the RSPs, so you get a tax write-off in this column. But then when you retire, you also get taxed when you pull the RSPs out. So for some people, you might want to hold your Canadian dividend bearing stocks in a non-registered account. One for the because these are for non-registered. Just to be clear as well. TFSA doesn't get taxed at all, so it doesn't fall on here. And the RSP, when something appreciates or pays dividends inside the RSP, doesn't matter. It stays in the RSP tax-free. But when you pull it out, you get smacked. So some people will choose to hold Canadian companies that pay dividends in a non-registered account because you pay taxes on the dividends in this column, like negligible, and then when you sell them, you pay on the appreciation you pay in this column. So just something to be aware of. Your financial advisor may just steer you towards an RSP TFSA. Your accountant may have a different opinion about it. Please do check with those professionals that you're actually compensating. So that's the tax table. So let me, for eligible dividends, yeah, and then it caters to investors, and yeah, I used a polite word there that it screws the workers and the savers. Any interest on your savings account also gets taxed here, and if you have bonds or bond mutual funds that pay interest, that also gets taxed in other income. And so that's why it's advantageous to put bonds. If you do decide to have bonds or bond mutual funds or bond ETFs, put them into a registered account, because in a TFSA, the interest from those bonds doesn't get taxed at all, and the RSP gets taxed the same as the interest. So just hold them in the RSP. So some general guidelines. I'm not a tax accountant, but just from experience and from reading the numbers. So generally use registered once your TFSA is exhausted. Your TFSA is going to beat non-registered anytime, because there's no taxes, and both of them use after-tax income. You use after-tax income to buy into the TFSA, and you use after-tax income to buy the non-registered stuff. So generally, after your TFSA stopped off, then you would want to go into registered. You would want to go into non-registered. If you're expecting losses, however, non-registered is the only account that can use capital losses as write-offs against capital gains. So this is kind of an interesting thing. If you have a stock that you sold and it made a loss, you can use that loss to offset a capital gain from another investment. If you lose money in a TFSA or an RSP, nobody's going to give you anything for that. So TFSA will always beat non-registered, as I said. RSP will beat TFSA if you're selling in a lower tax bracket than you're buying, because you got the tax credit up front. TFSA equals RSP in performance if you buy and sell in the same tax bracket. But you're also in that you're ignoring that the TFSA you have to pay the taxes on first before you could buy the TFSA. With the RSP, you obviously pay the taxes later, so there's a time value of money there, and I mean it could be a 20-year difference, so there could be a difference. And a TFSA will beat the RSP if you're selling in a higher tax bracket than buying, especially if you had capital gains. So as I said before, students should be investing in a TFSA or possibly non-registered, but save the RSP room for later. I guess we're all ever hopeful that we're going to make more money later on. So let's see, what other question did we have? Are we getting a tax write-off that higher than the dividend? Yeah, I'm assuming this is about this negative here. Yeah, it sounds like it's a tax credit. I honestly don't know the details of it. But you certainly don't pay taxes on dividends if you're getting under 50 grand. So for a US investing account, as I said, dividends that are coming from a foreign country, they get taxed as other income. Now, if you do want to hold companies in another country, then hold them in your RRSP, because the dividends will get taxed as other income once you pull the money out. So it'll get taxed as other income, whether it's in an RRSP or non-registered. So you might as well hold them in an RRSP. The RRSP has an extra benefit in that 15% tax, 15% dividend withholding of US dividends. The RRSP does not withhold them. So if you want to have dividends from other countries, then hold them in an RRSP is the short. Let's see, do these percentages apply inside TFSA and RRSP? So this is all non-registered. TFSA, you had already paid taxes on the money that you're putting into it, whether you did it by being paid a salary or selling assets. You got the money for the TFSA somehow, you pay taxes on it already. Money that goes in to the TFSA stays in there tax-free, comes out tax-free. RRSP, as I mentioned, will give you a tax credit when you put the money in, so you get the tax credit in this column. And when you pull the money out, you also get taxed in this column, but you might get a 20-year tax deferral where the money grows tax deferred. But when you pull the money out, you still get hit. Let's see, do these percentages apply to, okay, so we answered that. And can a business buy dividends of another company? I'm not sure exactly what that means. A company can buy stocks that pay dividends. A corporation, like a private corporation that some people have, that business owners have, can get its own trading account and buy. It's a non-registered trading account, just to throw that in, because a corporation will never die, never retire, and it's not a person. It cannot have a TFSA or an RRSP, so they're non-registered. But inside that, you can buy stocks that pay dividends. Absolutely. Let's see. Seems like if you have a super high growth asset, it should always be in a TFSA, as those gains will be completely tax exempt. So let me read that again. This is a very interesting question, and one that I think a lot of people struggle with, and there is no right answer. It seems like if you have a super high growth asset, it should always be in a TFSA, as those gains will be completely tax exempt. So if I have a high growth asset, meaning I'm going to get a big capital gain, I certainly would not put it into an RRSP, because you would get taxed on it severely when you actually sold that within the RRSP and pulled the money out. The TFSA is a possibility, but because of the capital gains being taxed at half of your bracket, you might consider it in a non-registered as well. It depends on your situation. But as I said, try to max out your TFSA first and then go into non-registered. The other beautiful thing that will happen is that if you put your $5,000 or $6,000 a year and that grows to 100, you pull the money out tax-free. Now you have $100,000 TFSA limit to go play with and maybe buy safer assets, because you sort of won the lottery a little bit. So TFSA is certainly a very good vehicle, a very good account for it. You might consider, especially if it's a risky investment, you might consider non-registered, because then if you lose the money, you can use it as a tax write-off. Capital, you can use it as a capital loss. You can use it as a write-off against capital gains that you've had. So for example, if you sell an investment property, real estate, that is considered a capital gain. So if you've lost money on some stocks, you can use that to offset the gains from that real estate sale. A capital gain is a capital gain. So that's a very good question, and yeah, TFSA would be a very, very good choice as well. Let's see, if I withdraw my growth from my TFSA, would that deduct from my contribution room? So I'm assuming if you pull money from the TFSA into your pocket, what that doesn't do anything right then, but on January 1st the following year, the amount that you pulled out recycles into your limit. So I'll give you an example. You put $10,000 into your TFSA. It went up to 15. You sold $7,000, immediately pulled it out. You now have $8,000 in your TFSA. You have $7,000 in your pocket. Everything's fine. January 1st, what happens is your limit for your TFSA, the amount that you can put in, now goes up by that $7,000 plus the fresh $6,000 for that upcoming year. So the limit recycles. Okay, so I hope I've answered all those questions. Great questions. Let's keep moving here. I think we covered these. Yeah, even non-registered will beat an RSP if you're selling in a higher tax bracket than when you're buying. So you have to be really, really careful when you're buying RSPs to sell them on an off year or when you're retired and when you're not making much money. So, all right. I kind of threw in just maybe some quick discussion points. Mortgages. These are sort of random topics. I don't really know if it flows all that well, but it's interesting topics. So mortgages, those of you who aren't aware, you can get a variable or a fixed, meaning either the payment or the interest compounded will vary based on what Bank of Canada sets its interest rates to. Fixed means you have a fixed interest rate and a fixed payment. You have to compare the interest rates and what you think will happen in the next few years as far as the interest rates, and decide on which of the mortgages you want. Open means you can put money in anytime and pay it down. Closed means you can't make extra payments, but some institutions allow you to double up your payments. Some institution will let you throw in another $10,000 on the anniversary and so on. If you decide to refinance, there may be penalties for getting out of a mortgage, and of course you pay all the lawyers. Quick thing about consumer debt, just my pet peeve is credit cards. If you have a balance on your credit card, don't even look at investing, because the credit card at best is charging you 10%, and it's probably 20 or even higher. There is no investment that after taxes, which you're paying for the credit card with after tax money, there's no way that there's an investment that is guaranteed to make you 20%. So pay down your credit cards first. Don't even look at investing. Something interesting, fewer and fewer of us have pensions at work. I think generally only if you work for the government would you still have some sort of a pension. They come in two flavors. The government is this one. If you do have a pension at work, it's likely this one. So defined benefit means they promise you a certain dollar amount per month or per year, no matter what happens with the stock market. So if you've been somewhere for 20 years, you might be getting, I'm making this up, $1,000 a month or something like that. So you get a defined benefit. So you know what you're getting. If your company goes bankrupt, you might still be out of luck if your company had a defined benefit plan. Obviously, government can't go bankrupt, so you're probably okay. But the trick here is that the risk is with the company. Defined contribution is where your company is putting in money for you. It might be a format of matching your contributions up to a certain point, or they're just putting money aside for you. But what happens with the market is at your risk. So on your statement, you might see that you have a balance of 150,000. And so if the market goes down, or depending on what it's invested in as well, of course, but that can go down, and that is basically what your pension is, as opposed to like a monthly payment till the day you die. So defined contribution is kind of the cheaper version of a pension. So if you do have a pension at work and you're not sure which one, ask your HR department and know how that's working. If there is matching of like if you're putting money into a pension and then your company matches a certain percentage of it, please make sure that you take advantage of that, because it's generally free money and it's part of your compensation package. So, okay, different topic, near and dear to my heart: becoming financially independent. If you're retiring, then you're hoping to be financially independent at that point. So financial independence is also called FI. It's part of kind of a movement, more or less secret, called FIRE, Financially Independent Retire Early, or retire early. And it's basically people who don't want to work till they're 60 or 65 or even 55, and they live frugally, and they usually make pretty decent money, but they work in a fairly high stress job, and so they decide that they're going to live frugally, they're going to save all their money, they're going to invest it, and then sometimes in their 30s they're able to retire. I don't think anybody actually really retires. They just change to a career that they enjoy, or they become bloggers, or they become trainers or YouTubers or something. Now, how do you get there? Key thing is have a diversified stream of income. If the only thing you have is your salary, then if you lose your job, you're in trouble. But if you have diversified stream of income, if you have rental properties, you have some dividend income, you're able to do some contracting on the side. You get some advertisements from your blogging website. You get paid by YouTube. You think you have a book in you, and you publish it online. If people buy it, great. You run a course, or if you do online selling, Amazon, whatever it is. If you have a diversified stream of income and you lose one of them, the others are able to compensate, and maybe you can spend more time on the others and maybe bring them up. So one of the keys is to have multiple sources of income if you want to be financially independent. It's not about retirement. It's basically having time to do what you want to do. It's about choices and independence, and being able to take time off anytime, and not being responsible to anybody and having to go somewhere 9 to 5. And so investing has gotten quite a few people there. And so one of the reasons I'm presenting this is that I want more people to become financially independent, and the investing is what can get you there. Or maybe just You can retire at 55 rather than 65. I mean, whatever it is. If you're financially independent and not working, you still would want to have an emergency fund of probably a couple of years worth of living expenses, again, so you don't have to sell the stocks if they do go down. So some of the tools for financial independence: know your expenses, so you know what income you're going to need when you stop working, because that seems to be the general goal. More so for people who are kind of in their 60s and are retiring normally, there's the 4% rule, which means that you can spend any given year 4% of your portfolio and you will not run out of money. So that's kind of assuming that you're going to live another 20 years maybe, and if you spend 4%, even if the market does a backflip, the 4% rules in historical backdated studies seems to kind of keep you from running out of money. If you stop working at 30, you might want to make that a 2% rule or 3% rule or somewhere lower. So your financial independence number is kind of your yearly spending divided by the safe withdrawal rate. So if you want to I did the math wrong on that. 1.25, right? Yeah, 4% rule means 25. So you basically multiply this number by the inverse of 4%. I have to pull out a calculator. Yeah, 125. So if you want 50 grand a year and you're okay using the 4% rule, then you need a 1.25 million to be financially independent. If you can live on less, then your portfolio goes down. If you're actually retired and you're getting CPP and old age security, then you probably don't need 50,000 coming out of your portfolio. Maybe you only need 30. Years to FI, financial independence number minus amount already saved divided by your yearly savings. So this is just a kind of a quick warning, because quite a few people think that they're going to live off the government. And yeah, Canada Pension Plan, if you've maxed it out, and hardly anybody ever does, currently it pays out 14,000 and a bit. Old age security, which is a little bit easier to max out, pays about 11. So together that would be about 25K. Depends on your lifestyle, that might be okay. For most people that would suck. So you may want to be saving something on your own. There's also the GIS, the income supplement, where they sort of bump you up to the poverty line. So if you're not getting any CPP, you are getting old age security, then the income supplement together with old age security can add up to 18 grand. So if that's your only income, it's going to prevent you from living under a bridge, but it's not going to make for the golden years. Are those numbers annually? So yeah, these are annual. These are all annual. The nice thing about these guys is that they are adjusted for inflation, so they do go up. So there you go. Okay, so again, changing topics, some portfolio examples. So this is actually my TFSA. I'm putting $166 a month into a Canadian index fund, 125 into US, and 166 into the international. So the index funds, it follows the Toronto Stock Exchange. The US one follows the Standard & Poor's 500 index. And this one follows the Morgan Stanley Capital Investments, which is a company, and Europe, Asia, Far East. So that's kind of the rest of the world. Now you're wondering what's with the funny numbers, and actually I had a financial advisor on the phone ask me that. So this comes to 458 bucks and change. When you multiply that by 12, comes to the 5,500 that used to be the TFSA limit. I could not be bothered to fill out the paperwork to get an extra 500 bucks a year in the TFSA. So that's my TFSA on a monthly basis, automated, just comes out. Okay. I don't know if you guys can see this. Let's see if we can zoom in a tiny bit. So these are other portfolios. I just pulled these off of, I think, Canadian Couch Potato. So on up here, you decide what sort of an investor you are, or a financial advisor will help you with that and will put you into the right portfolio. And then, so the options are Canadian Bond Index, Canadian Index Fund, US Index Fund, and International Index Fund. So the bottom three will be largely what I have here. And then depending on what sort of an investor you are, you can be conservative, where you'll be 70% in bonds, which I mentioned previously are safer, and then just 10%. Or you could be aggressive, where you have 10% in bonds and basically a third in the others. So this could be a portfolio that you're buying into every month. It could be a portfolio that you put an inheritance into, whatever it is. And then you would want to rebalance it, as I said, once every 6 months or once a year. This is another one. This is just using a bond index. It's using Canada, all capitalization, so all companies index. So this is basically all of Canada. And then this one is all country world, excluding Canada. So the middle one covers Canada, like every single stock that's public. And then this one covers every single stock in the world outside of Canada. And then you've got some bonds for that piggy bank I had mentioned previously in the last session. So again, depending on what kind of a investor you deem yourself to be, you would pick these different percentages. Any questions on this? This is, I think, fairly simple, but it's as simple as this. If you want to go do it by yourself, you can. Your financial advisor will probably use mutual funds instead of, and I mean actively manage mutual funds instead of either index funds, which these are, or ETFs, which these are, but it depends on the financial advisor. And off you go. Like, you don't have to pick individual stocks unless you want to. Does the Canadian index ever really outperform the US? On occasion, but absolutely not very frequently. When energy does well, when there's a really strong economy all over the world, then our resources are needed, and then the TSX will outperform the S&P 500. But yeah, we've had some tough years, like the last decade's been horrible. So obviously do your research, make your choices. You can hedge your bets by buying a little bit of both. As you see in mine, if you remember at the beginning, I said that I believe that the the emerging markets are going to do well in the long run because they have a young population and so on. So you can see I've sort of done my portfolio. Yeah, homegrown, US, just because it's sort of 50% of the world stock markets. But then I put a strong input into the international. That's my investing thesis. I'm using it as an example. Choose your own. and allocate your money as you wish. And then so this is a mutual fund example. I do this one every month as well into my corporate portfolio. So every month I buy 300, 200, 200, 300 of international equity, tax effective balanced. Tax effective means that it doesn't trigger taxes very much. This is because it's a corporation, it's a non-registered account, and it is a balanced mutual fund, so it does have a bond component. Then we have Canadian, and then we have global small caps, so global small companies. You have literally thousands of different investments that you can choose from, or your financial advisor will help you. Okay, so mutual funds. What you want to do, and we'll do a little bit of mutual fund analysis. I'm sorry it's 8 o'clock. We're not quite there yet. I hope you guys can stay with me. I do apologize if we're going over. So I use the Morningstar.ca. It's a research company, and they have a .com version as well. Make sure you get the .ca, and they have a star rating system. And so what you do is you're looking for 5-star mutual funds if you're doing this on your own. If a financial advisor is picking funds for you, do a little bit of research and make sure that you're getting 4 or 5-star mutual funds. And so what you want to do is get 5-star mutual funds that will outperform other mutual funds in their category. That's what the 5-star means, is that they're in the 10% of their category, and I'll show you what the category is in a sec. As well as outperforming their indexes rather than just following them, which is usually what the index tracking ETFs and index mutual funds do. Keep in mind that all results are after the MER has come off. So what you would look for, star rating 4 or 5-star, that means it beats 70 or 90% of the mutual funds in their category, exceed the index. Be aware of the MER, but make sure that it's the performance that matters. And check the category so you know what the index invests in, and I'll talk about these others when we actually get to the example. Be aware of mutual fund loads. So loads just means fees. They come in different flavors. Front end means that they'll charge you something right up front. This isn't really done anymore, but 20 years ago, you could have a financial advisor that would send you a mutual fund for $10,000 and invest $9,500 for you and just pocket the 5%. You're okay with front end 0. That's perfectly fine. Deferred sales charge, it's a decreased sales charge if you sell before 7 years. It's pretty much illegal anywhere other than BC. The financial advisor gets a hefty commission on these, so they kind of like them. You don't have to keep the exact mutual fund, but you do need to stay with that mutual fund company. So if you don't like that mutual fund's company's, the mutual fund that you're in, you can get your advisor to sell it and buy a different mutual fund, but it has to be from that same mutual fund company. Otherwise, you'll pay this deferred sales charge. And it'll be the first year if you sell, I think it'll be like 6%. Next year it'll be 5.5%, and so on down the road. Low load, similar thing, except it only goes up to 3 years. No load, you can sell at any time. So what you're looking for is front end 0 or no loads. So be aware of the loads. They've sort of gone away over the years as people became more aware of them. All right, so here's a mutual fund. I scratched out what it was just so I'm not making recommendations to you. So this is a 5-star fund. So if you want to do a real quick check, you look for 2 things. Number 1 is the number of stars up here. And I think on Morningstar.ca, you will now have to create a free account if you want to see the stars. They just want people to create accounts. And then down here, you have the performance. So the blue is the fund, the yellow is the category, and I mentioned category previously. So here's the category. For this fund, it happens to be Canada Fund Global Small Mid Cap Equity. So Morningstar has like 60 of them. They do get quite detailed. And so it's outperforming its category. And then there's an index, that's the red. So that's a benchmark that is being used for this mutual fund. As you can see, it's outperforming all of them. It's sort of running parallel, but there's always an ever increasing gap. So these are kind of the two touch points to look for on a mutual fund. The other stuff you want to look at is the fund size. You don't want it to get too big. Like if it's getting over 10 billion, the problem becomes that if they want something, they can't buy enough of it without increasing the price of it. So what they thought was, this is a good price, we want to get into this stock or whatever it is. As they start buying into it, they have so much money that it starts driving the price up. Okay for the performance of the mutual fund, but they're not getting it as cheap as they wanted to. Trailing yield for the last year, so yield is the dividends. So the stocks that are in this mutual fund paid 0.3% of a dividend. Not really anything significant. This is the MER. Now this happens to be a do-it-yourselfer. So if it's one that your financial advisor sold you, this would be commission advice or something like that. And then the MER would likely be higher because they are paying commission to your financial advisor. We'll talk about financial advisors in just a second. This particular one has a $5,000 limit per account. So in your TFSA, you could have $3,000 worth of one mutual fund from this company, and then $3,000 from another mutual fund from the same company, and you're meeting that limit. Investment style, so this is a grid. You get the north and south is small, medium, and large companies, and east and west on the horizontal axis is value versus growth. And really quickly, growth is usually smaller companies that are still growing. They're increasing revenue quickly, and they're investing all the money back into themselves. So they may not even be making a profit, but their price appreciation is based on future income, future profits. And so think of a young Apple. And then on the left-hand side here, if it was this lower left corner, that would be value. And value is once a company gets large, it sort of stabilizes, it starts paying a dividend, or it might actually fall in price and actually be a good buy. So value is kind of the other thing. Growth and value take turns outperforming each other. It's a bit of a flip of a coin, frankly. So risk level, this kind of gives you an idea that there's probably going to be some volatility. And as you can see, this is the drop in March. Okay, any questions? There's all sorts of information on Morningstar website. You get the performance sliced and diced various ways. So you can see this mutual fund had been in the top of its category for most of the time. So how to begin? Get goals. Know what you're saving for. Know what you're investing for. Know where you're going. Know your time frame, as I had said previously. If you don't know whether you'll need the money in 6 months or in 20 years, it's really difficult to choose something. You can use two approaches. You can use top-down, where you have an investing thesis that ties everything together. So poor countries with low average age grow fastest as people are pulled out of poverty. So that's my thesis. Again, choose your own. And then we compare all our investments to our thesis. And are we saying, is it conforming to what we're trying to do at a high level. Bottom up is kind of the other way. You pick individual investments that will outperform the overall market, and you get a mishmash of hopefully well-performing stocks. Determine your risk profile. We talked about that. Decide on the portfolio. Are you going to use mutual funds, ETFs, or stocks? Choose a discount brokerage. Moneysense.ca is an online Canadian magazine, very good one. Lots of great articles, and they do an evaluation of online brokers. This is if you want to go on your own. If you're doing it with a financial advisor, they'll help you with this and obviously provide the brokerage back office. Check the annual fees before you sign up with the brokerage on the various accounts. Kind of know whether you want to do an RSP, TFSA, are you doing an RESP for your child, that kind of thing. Some of them will charge annual fees if you don't have at least $25,000 with them, so be aware of those, and maybe go to a brokerage that doesn't charge those fees. Know what no commission ETFs the brokerage supports. Maybe it lets you buy anything without a commission, but then they probably make their money elsewhere. So make sure you do a little bit of research. It's not rocket science. Pick your account type. You can usually apply online or fill out a form. 10 years ago, I would send them a void check. Now I just enter my account information into the application online, and they hook me up. The brokerage will link your checking account with the brokerage. So before you buy a mutual fund, you would need to transfer money over. You would pull it from the brokerage. It's all very simple. If anybody's used Tangerine or any other online bank, it's the exact same idea. Then you would pick your stocks, ETFs, or mutual fund. If you want to do regular withdrawals, you can do a pre-authorized payment form, whether online or paper, depends. And then just transfer the money from your checking account into your trading account, and off you go. Okay. So that's kind of, if you haven't started, this is what you would do. If you want to use a financial advisor, they will do most of this for you, and they'll just talk with you, and they'll determine what account type you want, and so on. I wanted to hit on some alternate investments just so you guys are aware of them. I'm not advocating them, but just so you know, there's stuff out there. Collectibles, art, classic cars, stamps, comic books, baseball cards, Star Wars toys that you didn't play with, all worth a whole bunch of money and generally appreciating. Real estate, I'm sure most people know kind of about a buy and hold and getting a renter into a property, and off it goes. Key with buy and hold is make sure that it has a positive cash flow, meaning you have money left over in your pocket at the end of the year, not on. So after everything's been paid, and maybe something's been allocated for the roof that'll need to be fixed in 10 years, and maybe something's been allocated for the fridge that's going to break, and something's been allocated for vacancy when you don't have a renter. Make sure that you have something in your pocket. How much you want to have in your pocket depends on how much you value your time. Okay. Wholesaling, also called bird dogging, is where you find properties for investors. So you don't have any money, but you have lots of time. So you go around various neighborhoods and you hand out business cards, and you say, if you ever want to sell your home, give me a call. I have a cash buyer that I'll set you up with. And 1 in 200 will phone you when they're in a jam, and it could be anything. And they say, I want to sell my house. And you say, well, I can set you up with an investor, and then you just hand that person over to the investor, but you have some sort of a contract where you collect a commission, whether directly from the investor or you take a percentage. That's up to you. I don't know very many people who've done this successfully. I would definitely be doing that on the side. I wouldn't have that as a job. It is a way of making money. A flip, I'm sure most of you are familiar as well. You buy a property and very quickly you fix it up. Some lipstick on a pig, maybe you add some value and you take out a wall and you move a staircase, whatever brings up the value, and then you try to sell it as quickly as possible. Uh, it's not an ongoing source of income, but you get a nice hit initially. Any of these can be done as joint ventures. Well, I guess flips in the buy and holds maybe, where you work with somebody else. So I've done a couple of joint ventures where, I had somebody who handled all the construction and I handled the money part. And then you split the profits 50-50. So you can set it up however you want. So private equity or private investments, once you get to a certain amount of net worth, these kinds of things sort of start popping out of the woodwork. And what it is, it's small companies that don't want to go public because that costs a lot of money and they have to share information maybe that they don't want to. They're frequently real estate related, but not always. It can be a company that's running a car wash and they buy car washes and they run them and they pay you. It could be a company that's running apartment buildings. There's others, rest homes, all sorts of stuff. They're usually reserved for, there's two classifications: accredited buyers and eligible buyers. And accredited, it basically means that you have this much in net worth, you make this much every year, or this much as a family, and so on. The minimums to invest are usually $5,000 or $10,000, but also $25,000, and they usually lock up your money. They tend to pay well, but they pay well because they're risky. And so if you get the wrong one, and I have, your money disappears. And not because it's fraud, it's just because something went wrong. So I owned a car wash, or part of a car wash, and they had a bad year and they stopped paying the monthly payments. So they don't pay you 7, 8, 9% in cash flow on a monthly basis, but the 9% is obviously annual. They don't pay you that because they like you. They pay you that because they have to in order to attract capital. You can invest in startups. You go to meetups and there's somebody who's starting up a company, and yeah, vast majority of them fail, but maybe they'll work. Private debt, I've never done this one. It could be generally online, I would say, where you lend money to people. Sometimes the money disappears, so I would be very careful there. You can buy commodities, gold, silver, oil, either through ETFs, or you could buy gold coins, even though I don't think that's recommended by most people. And you could trade currency. So if you have a strong feeling that the American dollar is going to get stronger, then buy American dollars today, and then when it gets stronger, sell them, and you'll have more Canadian dollars. Okay, I hope everybody's still with me. I'm not seeing any questions, so I'm hoping this is all pretty. MICs are alternate that don't require you to be accredited. Yeah, so there's MIC mortgage something corporations. Yeah, so somebody's mentioning that there's another alternate investment, mortgage investment corporation. Thank you. The private equity is a very interesting field. I get mine through a salesperson who they put on presentations every so often. Nice dinner at the keg, and you get 2 presentations from 2 companies. Even if you don't buy anything there, it's you get a free dinner out of it. But that's not why I go. But you get to listen to somebody's business plan. And it's kind of cool to see how a multi-million-dollar company works. As compared to the stock market companies, though, these companies are minuscule. And the first time you know that there's a problem is when you stop getting money in your bank account. They don't have to disclose anything whatsoever. But the nice thing is you can get to talk to their CEO if you want to. Like my sales guy arranged meetings and phone calls. So it's an alternative though. So I didn't make this point. It's an alternative to the publicly traded stuff because something bad happens. You know, the COVID thing is a little bit different because that does affect those apartment buildings, for example, when people can't pay rent. But for example, when when Russia invaded the Ukraine, nothing happened to these investments while the stock market sold off. So, people still need some place to live. Apparently, they'll still get their cars washed and so on. But I have had some negative. There was a $10,000 investment, and if I'm lucky, I'm going to get 1,600 after the lawyers and everybody get through with it. So there's no return without risk. Okay, let me close this off talking about financial advisors. Give you a couple of websites, a couple of books, and I'll have you guys out of here. So yeah, financial advisors. So in here, I'm counting both people at the bank and then independent financial advisors. They get paid in various ways, and please find out how yours gets paid if you have one. When I first started investing, I'm like, oh no, this is personal. I'm asking this person how it gets paid. No, it's coming out of your pocket. Make sure you know. So they'll get paid by commission from the sale, depending on if it was like a deferred sales charge, like I mentioned earlier, they get that 5%, or they may get nothing, and then they just get paid a trailing fee. So for every year that money is invested with that mutual fund company, they could get anywhere from 1/4 to 1%, depends on the mutual fund and other things. So that's how they get paid. There are some that get paid by the transaction. My mother's financial advisor just one day said, oh, well, we'll just sell this and we'll buy that, it'll be better. And I looked at those two stocks and I'm like, is it though? But she paid $800 in a transaction fee. So there's something called churning, where they just trade stuff just to make a buck. They could be paid a percentage of assets, which sort of aligns their interests with yours, that the more that you're worth, the more they get paid. Or what's sort of becoming popular recently is being paid by the hour. So if you have a large portfolio that you're running yourself, you're saving on a whole bunch of fees, but maybe once every couple of years, pay somebody, $1,000 or $2,000 to give you a sober second thought. Just an idea. So the financial advisor will give you a KYC, know your client. It's usually 20 questions, or they could just talk to you. It depends on the bank and on the company. And they find out what your risk profile is. And then there's usually just a preset portfolio. Like if you score 1 to 10 on the questionnaire, they'll give you a very conservative portfolio. If you score 11 to 20, they'll give you a slightly more aggressive portfolio, and there's like 20 of them. That's how it works in some facilities. In the US, I don't think it's so much here. They're having a big discussion over fiduciary duty versus suitability. So fiduciary means that they have to do what's in your best interest, while suitability means they just have to sell you something that's suitable to you. But if it pays them a high commission and maybe doesn't perform as well, which is the conflict of interest, which unfortunately financial advisors have, that still meets the suitability criteria. So you're looking for fiduciary, but I don't know if that's a Canadian thing as well or just US. But you can always ask, are you going to do what's best for me, or are you going to do what's best for the both of us? So I believe that if you educate yourself and you do a little bit of reading, you can set up a simple portfolio for yourself. However, financial advisors do add value if you get the right one. So how they add value is they do and update financial plans according to your goals. They'll do that rebalancing and updating of your portfolio. They'll teach you something. They'll check on, do you need insurance? Do you need a will? Here, I can refer you to an attorney. Maybe they'll check in on a mortgage. Some of them might go as far as, helping you with your budget so you actually have money to invest. So they need to add value. If they just sign you up to a pre-authorized purchase and then never see you again, then why are you paying a higher MER to pay them a commission, right? That would be my question. So one place where they can add value is that they'll talk you out of selling when the market is down. They'll talk you off the ledge, because every investor says, okay, I'm a long-term investor, but you get a couple of negative months and they start panicking and they want to sell just when it's reaching that bottom. And so the financial advisor will talk you out of selling proactively, so you don't phone them all panicked. They'll educate you, and of course they'll recommend investments. Just picking mutual funds isn't really good enough, I would say, because with the amount of research that you have available today, you can probably do that research yourself, but they need to add that value. Here's a kind of a next phase of, if you have a financial advisor, of how to look at performance. I've had a financial advisor say, congratulations, this year you've made 8%. And I'm like, okay, but what did the market do? Now, if the answer is, well, the benchmark did 12%, then I'm like, you've got me in the wrong funds. If they said, well, the market did 5%, I'm like, good job. You have me beating the market. Keep in mind, a lot of people will just look at the absolute value. They'll cry if they made a negative return, and they'll clap if they made a positive return. But even negative returns, like the market sometimes goes down and there's no place to hide. But if your portfolio lost -5 and the market was -8, your financial advisor is doing the right thing. So, and of course your own portfolio, compare it to a benchmark as well. Don't just look at the absolute return value. Was it positive or was it negative? Okay, great financial advisors don't just pick mutual funds. They get all of your life together and they show you the blind spots and the problems. They show you that they know your life. They know you. A bank financial advisor, if they have 600 clients, that's sort of tough. But maybe they take good notes and they have good memory. They point you to what's important to you out of that huge amount of information that you can find on the web. They'll tell you to do nothing if the market is crashing. They make you stick to the plan. They'll do risk management for you. They'll adjust your portfolio if you freaked out because your portfolio lost 10%. So they'll say, okay, well, I guess we should throw more bonds in here because this person isn't handling the volatility. They'll help you with the budget, ensure that you're saving into the right account types, which we talked about. As I mentioned, the example of my friend, which was a true story, he was in the wrong account type. Anyway. Also, you need to be aware of how to take the money out later. Do you start taking money out of the non-registered first, out of the TFSA first, combination? They should know some tax laws. Financial advisors could also work with your accountant, by the way. The good ones. The ones that have 100 clients rather than the 600. They'll point out opportunities, they'll point out weaknesses, and they'll take a look at the big picture for you. They're a professional, dispassionate person who's not playing with their own money, and so they can be logical about it. while individual people will panic sometimes. Be willing to pay for great advice. There's no doubt about it. If the financial advisor adds value, they make you feel better, and they give you good returns, they're worth their price. So robo-advisors are fairly recent addition. They're basically websites which will invest your money for you, but they don't have any physical branches. They're kind of like Tangerine and all the other online banks, except this is for investment. So you do everything online. Depending on the Know Your Client questionnaire, they'll determine a portfolio for you. They'll keep it for you. They'll rebalance it for you. The portfolio is usually low-fee ETFs and index funds, but they will charge you a percentage of assets. Some of them will, if you have under 25,000, they won't charge you anything because you're just starting out. Others will charge you 50, like 0.5%, and then maybe they'll ramp it down, maybe they'll ramp it up. Like it just depends on what their business model is. Now remember, even if you have a financial advisor, no one will take as good care of your money as you. It really pains me that throughout my life, I've seen so many people go like this. Here's my money. I trust you. And that trust but verify, somebody said. So make sure you know enough to be able to look at what you have if you have a financial advisor and be able to ask questions. Towards the end of my relationship with my last financial advisor, it was a cooperation. He would suggest something, he would pitch me something, I would go look at it, and I would say no, yes to the 3 mutual funds that he suggested. Okay, we're nearing the end. So Morningstar.ca I mentioned. Stockchase.com is good if you want to look at individual stocks or ETFs. MoneySense is great for personal finance, investing, all sorts of stuff. Canadian Couch Potato is low cost portfolios, some good reading. And then if you want up-to-date business news, bnnbloomberg.ca is the website. Reading list, I'm sure most of these are familiar to at least a few of you. The Automatic Millionaire, that's about automating pay yourself first by taking money to invest before you have a chance to spend it. Rich Dad, Poor Dad, interesting reading, some interesting theories. Kind of an interesting way of looking at it. 2 things. One, people define assets like on a balance sheet, like a car is an asset, mortgage is a liability. He defines them differently, which I think is quite intelligent, where he says an asset is something that makes you money, liability is something that loses you money. So it's a personal finance book. So for example, a car or a house that you live in are actually liabilities because they cost you money. They're convenient and they keep you dry. I guess both of those keep you dry. So it's an interesting way of looking at things. The other thing is your wealth shouldn't be just in dollars, but it should be how long do you not have to work. That brings into your lifestyle choices and your expenses into it. So, you know, somebody could have $100,000 and be able to live on that for 10 years. And then there's somebody who will burn through that in a year and go into their credit card. So definition of wealth, how long do you not have to work? Wealthy Barber, kind of simplistic reading. It's good for beginners who know nothing about investing, insurance. It's a good beginning book, and it's kind of in a story format, so it's not terribly dry. A Millionaire Next Door, again, personal finance book. They did a study of millionaires because somebody wanted to market to them, and so they're a millionaire isn't. I'll give you the punchline. A millionaire isn't the guy in a $5,000 suit and a $100,000 car. It's actually likely that guy is deep in debt. in order to present as rich. All right. That concludes kind of what I wanted to cover. Is everybody shell-shocked, or anybody have any questions? All right. Well, then I'm an excellent communicator. Yeah, you guys are most welcome. I hope you guys got good value out of it. So I do have a scheduled, and I'll put this, I'll put up the recording up on the website one more time. I have one more scheduled for Monday, which is kind of a general question period. We can talk about what we covered here or anything else related to investing and finance. The website that I'm putting stuff on is the meetup.com page, which is kind of the homepage of the meetup. If you came in through one of my friends or associates, then just let, use them as an intermediary, and we'll get you the recordings. It's just the link up on Zoom. So I do have a question period on Monday. Yeah. So yes. So yeah, the videos are on the site, or I can get you them. So somebody's asking about analysis of stock purchasing. So yeah, somebody else had asked that as well. So I do have a presentation on individual stock analysis because that person is not available until next Friday. I'll do it in 8 days. It is a little bit more advanced. So keep that in mind. Like this was kind of basic investing, very simple, do it yourself. Stocks, yeah, you'll be doing it yourself, but stocks are far more volatile than a mutual fund would be. So there's also a lot more risk associated, and even the experts are wrong very frequently. So I'll do that one in 8 days. I'll schedule that then. So so somebody who had been asking for that. So it looks like I have 2 people who wanna come to that. Depending on how people kind of respond from here. I've got a couple of weeks left of the meetup, so I could do a couple more sessions if there's interest. Otherwise, I'll sort of shut everything down, and we'll call it hopefully a small group of people enlightened. So unless there's any other questions, I will bid you guys good night. I hope everybody got some good value out of it. All right, good night, guys. Thank you.
Thank you, Alice. Was excellent. Thank you.
Oh, good. I'm glad you enjoyed it. All right, I'll see you on the next one.
Yes, thank you. It was great.
Thank you, Alice. Thank you. Bye.
Thank you.
All right. Everybody.